Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Hi, I'm your host, Erin Allen with BMO ETFs. Welcome to today's session on infrastructure investing. So today we're going to be discussing the benefits of including this alternative asset class in your portfolio, how it can help lower volatility, how it provides greater diversification in times of inflation, and we'll discuss the key theme of renewables infrastructure and some ways that we can get access to these areas through ETFs. Just as a reminder, today we're not going to be providing you with any advice or investment recommendations. Today's episode is about providing education and information around the markets and around using ETFs for investors who are really looking to take charge of their own portfolios. With me today is my colleague Vish, portfolio manager at BMO ETFs and infrastructure expert. Thanks for joining us, Vish. And Joe Idaszak from Brookfield Public Securities Group. So Joe's focus on listed public infrastructure securities, and I'm so grateful to have you on today to bring your wealth of knowledge and expertise around infrastructure. Brookfield, of course, is certainly a very well-known name in terms of infrastructure, known for its expertise and its long history. And Brookfield actually manages two active ETFs for us that we recently launched. TOWR, Tower, and GRNI, Green Eye, which we will be getting into more detail on as the show goes on. So thank you both, Joe and Vish, for joining me today. Before we get started, just a quick reminder, please check out our YouTube channel where you can watch any of the past episodes that you may have missed. Remember to subscribe and ring the bell so that you are notified every Friday as we go live with our new episodes. Now, our 1-minute update. So all eyes this week were definitely on the US inflation print for July, which I think it's too soon to celebrate, but came in lower than expected and down from the previous month. So it was 8.5%. And I think one of the real surprises out of it was that there was a much smaller than expected rise in core prices as well, up about just 0.31%, which is at the least in 10 months. So that's all good news. It's too early to call victory, but definitely seems like it's sort of stabilizing in the US. And then another interesting development this week, which ties ever so nicely into our discussion, was the passing of the US's Inflation Reduction Act. And I'm sure Vish and Joe, you guys are going to be talking about this, but it looks like it's going to have quite the impact on the infrastructure sector and renewable infrastructures in particular, with the $700 billion bill, including close to $370 billion in climate and clean energy related spending. So more on that in today's discussion, but let's get right into it. Vish, it's great to have you on the show. Can you walk us through why alternative asset classes like infrastructure are so important in today's environment?
Yes, so I think it's a timely discussion talking about alternatives and so on, and a reason why the traditional 60-40 allocation to stocks and bonds may perhaps not be enough looking forward to meet long-term goals. You look back over the last 50 years or so, it was traditionally the gold standard for buy and hold investors, delivering good combination of growth as well as substantially less risk than either just stocks or bonds. But looking forward, especially given low bond yields and so on, there's a good case to be made that the 60-40 portfolio of old may not be sufficient to keep pace with inflation or provide the risk control that investors are looking for. And with regard to the latter point about risk control, the diversification potential rather of such a portfolio is in question, given that in the particular types of volatile periods that we've seen, lots of episodes of in the last couple of years, we've seen both bonds and stocks fall. So, investors have been looking for alternative sources of return. in order to provide perhaps better diversification potential. And with yields on fixed income being so paltry for the last few years, that yield hasn't been enough to cushion portfolios during these episodes of market downturns. So one of the greatest promises and potential of alternative asset classes is the diversification potential, the opportunity to offer a return stream that zigs, perhaps when other assets are, zagging. And because of their low correlation to other portfolio holdings, the effect is that they can often smooth portfolio returns and lower overall portfolio volatility, provide some alternative sources of return beyond the traditional broad-based equity and fixed income sources of return. And one of the sources of one of the alternative asset classes that has really resonated with investors looking for liquid access to an alternative has been infrastructure, and that's what we're going to talk about today.
Absolutely, yeah. So in infrastructure, while it's definitely not recession-proof, the investments are resilient and they're resistant, and in good times or bad, we're all going to need roads and electricity and all of that. So they are definitely very resilient securities. Vish, sticking with you, can you walk us through the different areas of infrastructure? Give us sort of the full picture.
Sure. Yeah. So just stepping back before we dig into the sectors, what is infrastructure? And I guess you can think about it as the essential underpinnings of modern industrial societies, all of the core physical structures that allow us to, function and enjoy modern life. You can think about it like physical structures such as transportation infrastructure, like roads and bridges and railroads and ports that allow all, commerce to happen across the globe. Energy infrastructure such as energy transmission lines and pipelines, telecom infrastructure such as cell phone, towers and so on, and of course water treatment, water delivery. So these are all core assets to modern life, and I think obviously these are pretty inelastic asset classes that you don't see demand vary too much depending on the economic cycle, and so for that reason it has a couple of key attractive characteristics that make it good to look at from an investment perspective.
Nice segue. Yeah, definitely the plumbing of our society. So what are the qualities of infrastructure that generally make it effective in these times of inflation or economic stress?
Yeah, well, I think one of the aspects that makes it perhaps a very good hedge or offset to the cost of inflation is that if you look at the nature of the underlying businesses across the infrastructure sectors, they're often supported by long-term contracts with governments or municipalities or cities, contractually set out profit margins, very, very long-term contracts. That's why it's so attractive to institutions with long-term liabilities as well, because the life of the underlying assets are similarly long-lived. And so this is something that produces very predictable cash flow, something very attractive to those looking for a yield component. And traditionally, the yield component of infrastructure equities has been significantly higher than that of broad market equities. The yield of global infrastructure has been at around 3.5% currently versus the S&P roughly around 2%. So there's a significant yield premium associated with that. If you look at the natural monopolies that kind of exist in the infrastructure space, there are very high barriers to entry. You can't just go out and build a new water treatment plant or set up another set of railroad tracks. Think of how inefficient it would be to have two nationwide railroad track systems in place. It's not really feasible. So because of that, these natural monopolies exist, and that sort of is like a moat, really guaranteeing that these companies, that these infrastructure facilities can continue to operate with predictability. And the reason the income generated from these infrastructure assets is thought to be inflation protected is because inbuilt into the contracts for most of these infrastructure operations are clauses essentially that allow them to pass through costs of inflation to end consumers. And because of the inelastic nature of the services being provided, people aren't going to stop driving, people aren't going to stop using electricity or using water. they pay those costs. So you can rely on the income being generated, and the providers can pass on added costs as a result of inflation to the end user. And so that's why it's got sort of baked in inflation protection. Then I guess another key thing that makes infrastructure equities very attractive when compared to other options is to look at, what are the long-term drivers supporting growth in the space. So whereas with traditional equities linked to individual companies, their fortunes, are dependent on the sales of a particular product or service. If you look at infrastructure, the driver is a much longer-term structural tailwind that comes from both developed and emerging markets, coming from long-term commitments from governments to either rebuild old infrastructure, like in the first world, North America, and in places where infrastructure has been in place for a long time, or in the emerging markets where in many cases a lot of the infrastructure is being built for the first time. And so there's a very long-term tailwind that should be supportive of investing in this sector, and it's not really dependent on the fortunes of one company quarter to quarter, or the success of one product or another. It's a very broad-based support. So I think there are a number of key elements there that are in favor of infrastructure investing.
Absolutely, very compelling. Thank you. Now, you're going to talk to us a bit about how we can get access to sort of the full market in a passive structure through an ETF. Joe's going to talk about the more active side. So Vish, walk us through ZGI, our infrastructure, global infrastructure.
Sure. Yeah. So ZGI is our global infrastructure index-based ETF. It tracks the Dow Jones Brookfield Global Infrastructure Index, and it provides one ticket access to a diversified portfolio of global listed infrastructure equities. And what's unique about this particular solution to provide access is that it provides exposure to the so-called pure play infrastructure space. And let me just digress for a moment just to distinguish between pure play and non-pure play. Pure play infrastructure refers to companies that derive the majority, in this case 70% or more, of their cash flows from the direct operation, owning and operating infrastructure assets. And so we would distinguish this from infrastructure related companies that maybe support these assets by maybe servicing the product. They don't necessarily benefit one-to-one from revenues associated with operating these assets. So the fund and the index that we track specifically focuses on pure play. So that really, in our view, provides the purest exposure to all of the promises that I outlined regarding infrastructure, because of these companies are deriving their revenues specifically from the operation of infrastructure assets. Typically institutions who have historically been investors in infrastructure for a variety of the reasons that I outlined in the past, they've accessed the infrastructure space through essentially private pools, and there's a very high hurdle to be able to do that in terms of due diligence and the money required and the timeline to deploy funds. And so the advantage of something like the ZGI, for example, it provides very liquid and transparent access to the infrastructure space, daily liquidity, and transparency regarding what you're invested in, and delivering substantially all of the benefits associated with infrastructure without some of the disadvantages of the traditional approach that as well are just outright inaccessible for most investors. So this particular portfolio provides exposure to over 40 different listed equities. And you can see the sector exposure. It's outlined on the donut chart there. I won't reiterate that, but you can see it's very well diversified, spanning a gamut between pipelines, REITs, gas, water, electric utilities, and so on. So all of the key global infrastructure sectors.
Perfect. Thanks, Vish. And this is one of the first ETFs we launched at BMO ETFs back in 2009. So one of the first, and certainly, just proves how well ETFs are democratizing investing and giving people access to these areas of the market that they used to have to go, was only available to institutions. We talked about how infrastructure can sort of be a hedge in inflationary times. Now let's prove it with this performance chart. Can you walk us through this, Vish?
Sure. So, I already outlined the reasons, why infrastructure companies, should be protected against inflation or act as a good hedge against inflation. And that's because the underlying businesses often have inbuilt inflation protection in their contracts and the ability to pass through costs. So that's the idea behind it. So how is it translated into actual performance? Does it actually, play out? So what we have here is a recent comparison that looks at performance of stocks from all the way back to 2008 up until the first quarter of this year, 2022, looking at three different elements. Number one, the Dow Jones Brookfield Global Infrastructure Composite. So it's a global index of global infrastructure type stocks. Number two, the S&P 500 in that sort of mustard color. And then the MSCI ACWI, which is a very comprehensive measure of global equity performance, including developed and emerging markets. And what this is showing is two different types of regimes. So a low inflation regime and high inflation regime, looking at the monthly average returns in low inflation regimes where the inflation is below a certain threshold, and then above a certain threshold, 2.25%, I believe it is, high inflation is what it's deemed to be. How have these different types of equities performed in these different scenarios? And you can see that on the left-hand side, the group of three bars, all three buckets of equities go up in a low inflation regime, and not surprising, but because of the lower beta nature of global infrastructure equities, we do see that the performance of global infrastructure lags somewhat against the full market cap weighted ACWI and S&P 500, which are very broad market equities. And so, that's as expected. But what is really nice to see is in the high inflation regimes, this is where global infrastructure really shines, and you see it substantially outperforming not only the S&P 500, but also the ACWI as well, too, turning in a robust, positive return, which is just proof of, what I'd mentioned before about the ability to pass through costs, and that's reflected in their operating results, that they remain essentially insulated and in fact still manage to turn in a positive performance during high inflation periods. So I think that is sort of the ultimate selling point for this type of asset.
The proof is in the pudding. Proved it there. Thanks, Vish. Thank you for walking us through the passive approach there. I want to switch gears. Joe, thanks for your patience. I'm excited to turn the discussion over to you. Brookfield manages, as I mentioned, the two ETFs for us, Tower and Green Eye. The one we're going to be focusing on today is the BMO Brookfield Global Renewables Infrastructure ETF. This was launched back earlier this year in Feb. But let's dig into the renewable infrastructure. Why do you feel that this area of infrastructure is such a great investment opportunity today?
Yeah, and thanks for having me, Erin. I really appreciate it. And I'm going to do a good job, I hope, of piggybacking off a lot of what Vish said, because the infrastructure asset class is one that we feel very strongly about at Brookfield, and we think there's a lot of great opportunities to put capital to work here. And renewables is no exception. In fact, for us, it's really the leading source of growth that we see within the space, thinking about the need to really focus on environmental positivity. And it's one where I think we all recognize it mostly through the efforts to decarbonize. And we think that the power sector is the first place to decarbonize. So the three different subsectors that you see as we've defined them on the page for you, renewable power and infrastructure, clean technology, and water and waste infrastructure do just that. They take out carbon emissions from the air. They clean up the way in which we're not just producing, but also consuming that electron, thinking about how that's going to permeate through into the broader electrification of the economy. And then ultimately as well, when we think about water and waste infrastructure, other pieces of infrastructure down the line, the need to really have that positive environmental impact. So it's one where we see tremendous amounts of growth. So you'll see at the top of the page, we say $100+ trillion opportunity. That might be a low ball, frankly, considering all the different spend that we need around the globe, and not just developed markets, but really, as Vish mentioned too, emerging markets. So thinking about the need to spend capital to change the way in which we're producing that electron through traditional fossil fuels, and now the way in which that we're going to produce it through new renewable sources such as wind, solar, and then maybe in a little bit down the road, the concepts of standalone storage or other parts of our grid that will change pretty rapidly in the next decade.
Yeah, definitely a really big emerging theme to watch. And yeah, it's just so exciting to see how everything is transforming right now. Walk us through a bit more around policy and how it's shifting around the globe around carbon emissions and how this is going to impact the sector.
Yeah, and you mentioned the Inflation Reduction Act, and I think it's a good topical piece of legislation for us to talk about in conjunction with this concept. But really, we've been pushing forward decarbonization from a policy perspective for some time. It's one where when I think about governments around the globe calling for a need to reduce our carbon emissions, whether codified or otherwise, we found ways globally to start pulling carbon emissions out well before the last couple of years. And it's one where I think really more so highlighted by the Paris Accord, but now maybe pulled forward a little bit more through the Glasgow Climate Pact. We're starting to see not just countries, but frankly, companies around the globe embrace this need to reach net zero by 2050. When we say net zero by 2050, ultimately, we do have to start, in our opinion, with the power sector as the root cause of all things emissions. And what we're seeing really now is a united front in order to take these emissions out. Using the Inflation Reduction Act as a proxy here, I think a couple of good things that we saw in that. One, it's the extension of tax credits for existing renewable power. So if we think about wind and solar tax credits here in the US, that's been around for some time now, but the decade-long extension of that, I think, allows a great runway to both pull forward some of the investments and then still keep that traction going for what we had, albeit a little bit muddied by the last couple of years here with global supply chains. But I think keeping that momentum going forward into 2030 gives us a really fighting chance to reach net zero by 2050. But even more importantly for me maybe is the addition of some new credits and the addition of things like standalone storage, like the hydrogen credit. A couple of those things I think are really important for pushing forward new innovation and new investment in areas that otherwise have not been as cost effective as maybe a wind and solar investment. So something like the Inflation Reduction Act or things that we're seeing maybe out of Europe with thinking more about energy security of supply of late. We're seeing, I think, governments around the globe unite around the fact that energy security and energy supply, where you can do it from your own home soil of producing energy through wind and solar, I think that's really important. And we're going to see that become even more important over the next coming years as we try to reach this goal of net zero by 2050.
Yeah, it'll be interesting to see how that Russia-Ukraine conflict really impacts it. You know, it definitely kind of, as you said, put a damper on things, but long term, that energy security, it's gonna take effect, and people are really going to be developing more around this, I think.
Very much so, yes.
All right, can you walk us through the different areas of renewables where you see the greatest opportunities going forward?
Yeah, this is one of our favorite slides, by the way, because it showcases, I think, a couple of things. One, really the electron growth. And between now and 2050, when we say trying to get to net zero, you can imagine that we need to grow that electron quite a bit within the piece of the pie for how we work our global economy. So when I say things like electrifying or the electrification of the economy, we start with changing the way in which we're producing power. So taking out coal from the system is a very obvious one from this chart, and really replacing that with new wind and solar generation. I think the really next frontier beyond that is also how do we then store that intermittent power and allow that to permeate through other parts of our economy. So the transportation sector is a key thing for us to focus on going forward, is taking out emissions from trucking or our cars or other parts of transportation where we get goods and services from point A to point B. You know, when we think about low cost solutions and alternatives, it's not going to just be a new wind farm or a new solar farm. That's just the start for us. When we think about pairing storage alongside of solar to maybe create more of a, we call it baseload power or consistency of power, where we take for granted when we turn a light switch on, it's going to stay on no matter what. We think solar and storage can start to make that more of a reality at a no carbon versus that of running it through a coal plant today. So that's a great example. I think also increasing the efficiency, as we've seen over the last decade or so, of these assets themselves has been really important. So a wind farm's gotten more and more efficient. A solar panel has gotten more efficient over that time frame, and it's allowed us to replace coal at a quicker rate. But I think it doesn't just start at shutting down coal. It's how do we capture other forms of carbon going into the future, because we won't run in a system that's fully carbon or fully no carbon. We're going to have natural gas assets for a very long time. And we need to think about how to really create an ecosystem to maybe capture some of that carbon or other ways in which we can get to that net zero construct. So we think about wind and solar as just a starting point. And it's I think the permeation of that $100 trillion of investment that we call on, it's not just going to be a wind and solar asset.
And you sort of segued into the next slide around capacity.
Thank you. Yes, yeah, of course.
I noticed that.
Yeah.
But yeah, I mean, the demand is definitely here, but can supply or capacity keep up?
You know, it's something that we have to grapple with every day. Is if we do want to get to net zero, we have to pull forward an incredible amount of investment in the grid itself. And in order to do so, that requires a lot of upfront capital, that requires a lot of raw materials, and that requires the ability to get those raw materials from point of access to then point of development and ultimately keep them up and running for a long period of time. So what we see, or what we're showing you on the page, is 2020 jumping to 2030, but then really the jumping point from 2030 to 2050 is quite immense. And it's one where we think that right now where we are is, don't want to call it too dire, but we need to start investing very fast and very quickly. And I think what we've seen over the last, call it 18 months or so, is the supply chain has been very stretched. And it's one where ultimately when we see maybe some alleviation points of that towards the back half of this year and into 2023, I do think you will start to see a significant amount of ramp up in development across the globe. Will it be at the right pace that we need? Probably not, but it'll be at a much better pace than what we've seen over the last couple of years here, coming out of the COVID lockdown starting in early 2020. So we're really looking for the next couple of years as the bellwether sign of, can we ramp the way that we want to ramp in order to get to net zero by 2050? So between now and 2025, we're going to have a few years of data points to showcase whether or not we can reach those capacity needs. But it's not just new wind and solar. If you don't mind jumping forward a slide, I think it's really the construct of thinking about the grid in totality. So I've talked a lot about taking out coal from the system and replacing with wind and solar. But we think about it like this. You're taking out one very centralized power station and interspersing a number of maybe smaller, more modular power stations. You need to have a smart grid. You need to have an active grid. You need to have a grid that understands that new point of production and then ultimately how that consumption node is going to change throughout the way in which we do electrify the economy, thinking about more demand from electric vehicles, more demand from other parts of our economy that will pull forward electric demand at not a normal time of day that we're used to. Think about what COVID's already done for us in terms of our power demand when working from home, different environments. The peak power demand is no longer just that period of time when we leave from our traditional work setting and go home at the early parts of the evening. It's now interspersed throughout the different parts of the day. So we do need to have a very smart grid that can be resilient, reliable, and we think that really, as you see here on the page, that's going to require a significant amount of spend on the transmission and distribution aspect, not just the electricity production piece of the equation. So it really is a full systems go investment for us here. And we think that really, maybe this is a good segue into thinking about our strategy, is why it's so important to own the full aspect of the grid and not just focus on one singular aspect.
Perfect. Thanks, Joe. Can you walk us through this slide and this chart in terms of what it's showing in terms of cash flows for renewables versus global equity?
Vish did all the work for me, so thanks, Vish, for this. Yeah. I'm just giving a couple extra data points here to showcase that. Is when he talks about the resiliency of cash flows, for us, the defensive nature and the long-term nature of all of the infrastructure asset class that we have to invest in, renewables are no different. We have long duration contracts. We have sometimes even they can be in regulation, but really these are assets that have 10, 15, 20, sometimes 20 plus years of visible cash flows that locked in contracts that have inflation escalators. What does that mean? That does mean pretty constant growth over a full life cycle of those assets. And it's important to pair that against that of global equities, where you do have other parts of our economy that have very fluctuating earnings during various points of economic volatility. So having this ability to showcase stability of earnings, having that ability to showcase growth over time, and this is a little bit more of a backwards looking metric than a forwards looking one, but when we think about it, over the better part of the last decade and going forward, you're looking at a average growth of roughly double that of global equities, and you're doing it through a much less volatile lens. So when Vish talks about the lower volatility aspect of infrastructure, the inflation protections that we provide, and the growth aspect, I think all of those things resonate very strongly through renewables. This is, in our opinion, the single highest growth area within the infrastructure asset class. So this may be skewed a little bit higher than what you'd see from traditional infrastructure as a heterogeneous asset class, but for sure, you're going to see something quite similar if you were to put all of infra over this. We just happen to have a much higher growth pattern. And the importance here, Erin, is that every single year is a positive green bar, whereas you can have various different amplitudes. Sure, that gray bar in 2021 looks quite high, but look at that gray bar in 2020. So to be able to keep that oscillation of volatility relatively benign, it's really important for putting that into a portfolio when we think about asset allocation.
Yeah, that stability is really a powerful picture. Walk us through how Brookfield is sort of leading the charge in terms of renewables.
Sure, yeah. We've been doing this for a very long time, Erin, and it's one where it's born out of the roots of Brookfield from the very beginning of the company, thinking about investing in hydro assets when the company was originally called Brascan. But we've been doing renewables for a very long time. We've been doing it at size and scale. And to be able to have size and scale as an organization where you have assets around the globe, and to be able to understand those different nuances of the regulation, the regulatory constructs, legislation, and where assets are best placed, I think that's really important and a great value proposition. So to be able to have the entirety of the Brookfield organization and that expertise on renewable power is incredibly important for our investors when we think about that value proposition for putting that to work in listed markets. Most of our assets, as you can imagine, are more so on the private side. So we're not just investors, but we're owners and operators. So to be able to have that both investment acumen, but really that industrial operational acumen as well as an organization, I think that's a very powerful piece for us.
Yeah, it definitely makes you guys unique for sure. And we're really happy to be partnering with you guys on these two new ETFs that we've launched. I mentioned we've been talking a lot about BMO Brookfield Global Renewable Infrastructure Fund, or Green I, but we also launched Tower, the Global Real Estate Tech Fund. And that ETF invests in listed companies in the technology infrastructure space. So playing on the themes around data centers, communication infrastructure, industrials, and both of these are really high conviction portfolios. So you'll see less positions than you would, of course, in ZGI, the broad market infrastructure that we talked about earlier. But Joe, I do want to give you a chance to walk us through the strategy behind Green I in a little bit more detail on the next slide here.
Sure, and I like that you call it Green I. I haven't called it that yet myself, so I'm going to steal that going forward, Erin, if you don't mind. But really, the way we think about this, and we've sort of touched on it already, we're taking this infrastructure lens to renewables. I think if you were to go out and ask 10 different managers about what they think or define renewables to be, you'd still get 10 different answers. But our focus, I think, uniquely on impacting the power sector first, anything that really bellies off of that power landscape, is one where our product is starting that differentiation point. So we're looking at companies that are specifically developing, owning, and operating that full aspect of the grid, like I talked about. Is we want to not just own a new wind and solar asset or a wind and solar developer. We want to think about the way in which that grid's changing over. So we do want to own companies that are impacting the way in which we're consuming that power as well, just as much as producing it. So that end-to-end model of thinking about the renewable power and infrastructure piece, where we do go from the new point of generation to then thinking about our homes and our businesses and how we need to consume that power, that's the vast majority of what you see within this portfolio. Where we don't invest, which is just as important as what we do invest in, is some of that more broader value chain type stuff that's more of the capital goods manufacturers, the the information technology companies. We don't have a competitive edge there, nor do we think that those are sustainable business models going forward. So everything that we look at and try to put in this portfolio, if it's infrastructure adjacent, we want to make sure that they have cash flows and they have meaningful cash flows going forward. So back to that chart where you were showcasing the green bar going forward, we're investing in companies that are compounding cash flows over time. And so this lower left-hand part of the bar on the right side, where we showcase return versus risk, it's not that it's a lower return product, it's just that on a risk-adjusted basis, and thinking about that amplified volatility that we were showing from global equities, we want to provide the best risk reward in the portfolio. So ultimately, when we're blending together these three different subsectors, we're trying to get a relatively low beta to that of global equities, call it something around 0.8 or so. We do still want to get a level of commensurate returns. I'd say somewhere around the 8 to 14% range is a good long-term thought process for how this product should compound over time. So when you put all that together in a portfolio, I think that's where we ultimately sit, is being closest to infrastructure within the renewable landscape is the way to play this game, is the way to play the energy transition. And ultimately, I think that you can still get some very competitive returns versus that of a broader global equity allocation. So hopefully that gives a little bit more flavor and color to the portfolio itself. Yeah, I'll pass it back to you, Erin.
Perfect. Yes, and we will have to have you back to talk about Tower. I think the infrastructure play is not going anywhere anytime soon. So it is
We sure don't think so. Yeah.
We will be talking about this again, and we'll have you back. So thank you for all your insights. We're going to switch gears into our audience questions now. So thank you guys all for submitting these questions. We love to get them. They give us ideas for future shows, and so keep them coming. And if we don't get to them on the show, I'll respond directly via email. Vish, I'm going to send the first one to you. In a high inflation environment, is the best solution dividend-paying ETFs such as bank stocks, etc.? What do you think?
Erin, I guess in a high inflation environment, a very good solution can be dividend-focused ETFs holding, constituents like bank stocks. If you look at just historically, dividends have always comprised, 35 to 40% of overall total return. So they're certainly an important, contributor to overall returns. And to the extent that the underlying companies are financially sound enough to be able to pay out dividends, that's positive. In particular, companies that have the ability to grow dividends have historically outperformed, non-dividend payers and companies that perhaps don't grow dividends. So that can act as a good hedge against inflation, to the extent as well, too, that perhaps a bird in hand is better than two in the bush. Getting some cash now can help offset some of the present costs of inflation. So I think strategies like dividend-paying ETFs can be, one good tool to combat inflation. But of course, the topic of this particular, webinar being infrastructure, I'd be remiss to not circle back just briefly to what we evidenced, right, through displaying the performance results of equities focused on, generating cash flows through all regimes and with inbuilt inflation protection, contractually, baked into their operating models. So of course, infrastructure is, perhaps one of the best solutions in a high inflation environment. It so happens, that's the case. I had to mention that.
Yeah, well-timed question for sure, and hopefully the person who asked that question pulled some good insights from today's show. The next question, is there an ETF option at BMO to access the pharmaceutical industry? So I could take that one. We do have a healthcare ETF, ZHU and ZUH. It's got about 15-16% exposure to pharmaceuticals in particular. This is also a very timely question, and I feel like I really nailed the timing of market insights lately, because this week we're talking about infrastructure, next week we're talking about healthcare. So tune in next week and we'll be talking about that as well, and how this Inflation Reduction Act is going to impact the healthcare sector. But another idea to consider that we'll be talking about next week is ZGen, which is focused all around genomic innovation. So that's sort of the future of healthcare as another idea there. Vish, I will turn this one over to you. The market has shown noticeable growth over the last week. Is this related to general market optimism that we have turned a corner, or is it related to the earnings season? If the latter, why is this the case if earnings have been mediocre?
Okay. I think a couple of angles on this one, perhaps two I'll tackle. One is, what's the underlying driver? And one of them, of course, I think you sort of tackled at the outset, the most recent CPI numbers, which suggest that perhaps, inflation is coming in a little bit lower than feared. So it's still high, but a little lower than feared. So that's a positive, sign. As far as earnings go, I don't know if I'd necessarily agree that earnings have been mediocre. I think it's been a very tough operating environment for corporates, with like very high input costs, supply chain challenges continuing to persist, and so on. Rates rising, and so on. And despite that, over 75% of S&P 500 companies have beaten, estimates in that environment and provided, decent guidance. So perhaps suggesting that they're able to navigate this turbulence. And, a side benefit of the carnage in the markets, to take the glass half full approach, is that, valuations have pulled back significantly to be a little bit closer to the long-term average. So all of that, I guess, is being, assessed by investors in aggregate, and has led to, some rallying in the markets as of late. And so that's what I would attribute most of that action to.
Perfect. Thanks, Vish. All right, so that caps off another great week of ETF Market Insights. Thank you to everybody who tuned in this week, and thank you to Vish and Joe for being my expert guests today. Next Friday, as I mentioned, on the 19th, we will be going live with Chris Heeks, portfolio manager at BMO ETFs, and Dan White, an analyst at ARK Invest, and we're going to be talking about healthcare and genomic innovation. So really looking forward to that. I hope you can join us then. Have a great day. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.